Hi everyone, this is Jimmy Lee. Um, I'm videoing this from London, England. I came to Europe for a business trip a few days back and made my way over to London. I'm actually meeting with one of our asset managers that manage international securities here in London tomorrow and visiting this wonderful city and one of the places that I love the most. But with that being said, what happened last week and over the weekend with the banking situation in the United States has a lot of investors, I'm sure, questioning what's going on and how this may impact their portfolios. And so I wanted to shoot this quick video to just give you my thoughts on what's going on and the people I've talked to in the financial business so far and all the things that I've seen and read so far and heard in some of the other interviews and give you my view on it. So with that being said, Silicon Valley Bank on Friday was taken over by the FDIC, and that bank is really a fairly unknown name to most consumers. But if you were in the technology business or the venture capital business, you certainly would have known who they were. They were the 16th largest bank in the United States. These, specialize in working with venture capital companies, and they would bank these startups. But that became some of the largest companies today. And so there are a lot of companies that are in the technology sector, in particular, that they banked and lent money to. And what happened with that bank was that there was a classic bank run or run on the bank that happened last week. That in just a short period of time, in just like 1 or 2 days, billions and billions of dollars were withdrawn by their customers. A lot of those customers actually being these tech companies, and the boards of these customers were telling, their clients, a lot of these startups and other firms to move their money just to remove the risk away from that bank, possibly going under, which is what happened. Then on Saturday, another bank called Signature Bank, which is the 29th largest bank in the United States at the end of last year, which is based out of New York, which was formed, I believe, in 2001. So over 20 years approximately. Started out as a bank. I read that serviced really high net worth clients. I know that did some real estate lending, but in the last few years really took a niche in the cryptocurrency business and banked a lot of companies in that industry. And I know that most of you have probably heard of what happened or what's been happening, in a lot of those companies that are in the crypto space. So, those two banks being taken over by the government was obviously a huge concern. And over this weekend, the government was trying to figure out what to do and announced before the opening today of the markets that between the Treasury, the Fed, and the FDIC, that they were going to create a fund where banks could borrow money or get money from the fund and pledge as collateral securities or government securities that they may have on their balance sheets. And what happened with Silicon Valley Bank was that probably in order to get a little bit more yield on their investments that they have, they went out longer on the yield curve, meaning they bought longer term maturity government bonds, treasuries. And when interest rates went up as much as they did last year, as many of you know, bond prices go down when rates go up. While those bonds are safe if they can hold them to maturity, if you have to liquidate them now, they're worth less. And that's what happened. And they needed to raise some money, less than $3 billion, but they made an announcement about needing to raise that money, which caused a lot of panic and people pulling their money out of the bank, their customers, which are major companies in the technology sector. So that's what happened. And what's going on today in the markets are, people trying to figure out what to do next and what kind of contagion there may be from this event. So is the banking industry okay in the United States? Absolutely. The banking industry, since the financial crisis that occurred in 08, 09, is much more capitalized than it was before. Obviously, some of these banks, the regional and smaller banks, not the big banks that you've heard of, but the smaller ones that lend to small businesses may act a little bit differently when they lend money and maybe lending money to companies that are smaller than some of the big banks do. with bigger companies, and so they may have a little bit different profile on their balance sheet in terms of who their customers are and who they lend to and what those loans look like. With that being said, this is just again a classic run on the bank. And could this lead to other banks going bankrupt or being taken over by the government? And that's an unknown. So I think that actually could happen. There's a few banks that their stock prices have been really slashed because of what their portfolio of assets look like and relative to their deposit base. And of course, what the government has done is come out and said that all the depositors of these banks over and above the FDIC limits will get their money. So I believe that that's a very good solution to the situation at hand. But what else could happen? Could some of the companies that are doing business with these banks also be under pressure? I know that over the weekend there were a lot of articles being written about companies and CEOs and CFOs that were talking about not being able to meet payroll because the bank had closed. I think for the most part, what the solution the government created will solve those issues, and hopefully this won't move into other areas in the financial world. As far as the implications for investors and their portfolios, what I've been praying for a while is that the Fed would stop raising interest rates sooner than later, and this event that occurred is definitely a disinflationary event, meaning that the Fed now has more reason than just looking at inflation reports to not potentially raise interest rates. And so this month, the money was on that the Fed would raise by 25 or 50 basis points. So that's a quarter or half of 1%. And now the chances are likelier that there may not be a raise at all, or maybe 25 basis points. And so, if they raise 25 basis points, I think that that would be okay. And could they pause after this month and then recontinue or continue raising rates later on in the year? Absolutely, that could happen. But I really do believe that the inflation numbers are much lower than actually they've been reported in the government data that we get. And I've been saying that for a large reason. I believe that is because of housing and what higher rates has done to housing in terms of slowing down new projects, and people aren't able to sell their houses or buy houses at the prices they can buy them at lower prices now. Excuse me. And but people that are trying to sell can't get those high numbers that people were willing to pay last year. Interest rates being more than double what they were over a year ago has definitely slowed down the housing market, which represents 40% of what the government calls core CPI. So core CPI is inflation outside of food and energy prices. And so when those numbers really get in the data, and the way that the government collects that data is with a rearview mirror, with looking back over 6 months. Once that starts getting into the numbers, and now with the situation with what's been going on with not just the technology sector that's been announcing large layoffs, but the financial sector that's going to be laying off a lot of people with these banks and possibly other financial institutions that may be looking at laying off people to protect their earnings and their profits. Definitely is going to be viewed as a deflationary thing. Also, what was causing inflation was stronger wages, which we've seen come down. And a lot of the jobs that will be lost or that have been lost in the technology and financial sectors are higher paying jobs. And not all of those people are going to be able to replace those jobs with the same kind of income that they were making before. So I think what ends up happening is that this is definitely deflationary. We're certainly seeing signs of that and have been seeing signs of that for the last few months, even the last 6 months. And while the consumer is still strong, and that's why we're seeing jobs still being created, people are still spending money. The lower end of the consumer, we're starting to see a lot of weakness, and have been seeing that for several months. You can see it in credit card delinquency rates going up, subprime auto loans, defaulting and things like that. But the mass affluent and the high net worth folks still have a lot of money, and so I don't think the consumer is really going to be tested until the summer. And that's important because the United States economy is made up of 70% approximately of consumer spending. So us spending money is a big deal when it comes to economic growth. So overall, we'll have to see how this will impact the economy in the long run. But when it comes to your money and your portfolios with us, I think that the Fed now having more of a reason to stop raising rates sooner than later is a huge net positive. And certainly, I didn't want to have a banking situation or a crisis of some sort to cause the Fed to stop raising rates sooner than expected. But the fact is, that's what's going to happen. And so we're going to see a lot of volatility, I would guess, over the next several days, maybe even weeks, based on how the situation unfolds. But I think in the long run, it's going to definitely create some buying opportunities for people that have their money in cash. For us, in terms of what sectors that we want to under or overweight, we're definitely going to be looking at our portfolios again and making sure that we're allocated properly. We're really happy about the performance of our model portfolios for 2022 for all of my clients personally and our team's clients, as well as all the other clients of all the advisors that work with the Wealth Consulting Group. We take this job extremely seriously. Even being overseas and with a little bit of jet lag, I've been up a lot doing a lot of research over the weekend and coming into Monday morning. Just did an interview with BBC, and tomorrow we'll be on Fox in the United States and be visiting with one of our money managers that we use in our model portfolio. So paying attention to what's going on and communicating with our team and for our clients back home. And just want to make sure that you know that we're paying close attention to this. And our base case holds true still for 2023, that we're going to have some volatile markets, especially in the first half of this year. But overall, at the end of the year, we think that this is going to be a good thing. And for those of you that are sitting on some dry powder and you have some cash, I think this situation is going to present even more opportunities to get that money to work. And while I think it's awesome to be able to get 4 or 5% on government bonds short term, I think it's kind of a sucker bet for the longer term investors. And so while it's very important for retirees and people that need liquidity to pay for living expenses, during a decline in the markets, it's always great to have a fund set aside. And we as advisors are doing that for you so that we don't ever have to sell your securities at a loss to fund current expenses. But in the long run, we think your money's definitely better off in not only potentially equities, but even traditional fixed income and bonds. We believe is going to present and will present good returns going forward. So that's it. And look forward to talking to everybody soon again. And hopefully we'll be able to do more of these videos in the future. Thank you.